Good evening, and welcome. Welcome everybody to another live stream. Today, we're going to be unpacking the question that a lot of people have been having recently, which is what is going on with the markets and ultimately what's been driving this sell-off that we're experiencing and where do things head from here? Of course, I'm sure if you've been watching the markets over the past couple of days, you've seen what's been happening in your portfolio and at a macro level too. There's been a lot of uncertainty. We've seen a significant sell-off. The activity in the pound and the UK bond market has been, of course, attracting a lot of attention. We've seen the soaring US dollar, but a lot of this has culminated in terms of us returning back towards the June lows and really testing those. And now the question is, where do things head? So today we're going to unpack this. We've got a few different data points to look at. And at the end, we'll reflect on the question that we don't have an answer to yet, but really probably the key question that the market is trying to work out right now. So we'll talk about what this question is and really why it's going to point to where things ultimately head over the medium term. In the short term, there's a lot of uncertainties. We're just about heading into earnings season in October for the September quarter. That'll give us a few more insights. We'll get another CPI print, get a bit more economic data, which of course the market wants to start to assess how the rate rises are affecting the broader picture. But for now, welcome. Hope you're all going well. Drop in, say good day. I've got to say, it is great to be back doing the live streams. It's been a while. We had a great live stream on Monday. We'll be dropping in live streams whenever there's stuff to talk about. There's going to be plenty of streams on this channel. They'll be exclusively on this channel. So if you haven't yet, make sure you've subscribed, turn your bell notifications on. If your bell notifications are on, you'll be updated whenever we drop a live stream. So this was a random one. There's going to be plenty more. It's great to have you all joining us back. If you haven't been in a stream for a while, pop up and say good day. If this is your first stream on the channel, say hello as well. There's plenty more to come. Hit the like button. You guys know it helps us out. And welcome. About time. Evening. Great to be back. It is good to be back. The dead cat keeps bouncing. It does. And testing, well, not lower lows yet, but we're testing the low so far of this move. Hope you're going well. Positive about the next CPI data, given the drop in energy prices. Yeah, there's been drops in commodity prices as well. Expecting the 75 bips increase, but the market's expecting that anyway. And we saw what happened as well with the Nord Stream pipeline today, which obviously is going to throw further curveball, further uncertainties in terms of the energy prices and the energy crisis in Europe. So there's a lot to take in on that front. Siva, good evening. It's good to be back. Yeah, things are good. Back in Australia for a few weeks, and we'll be back over to Europe mid-October. So things are going well, but plenty more live streams. That's the main thing. Can't wait to get them back. We've got this new set as well. It's eventually meant to be interactive. For now, it's a static one, but it's going to be dynamic and it's going to light up and things. So stay tuned. Good evening. Another rough day. It was, Deco. It was, mate. Hope you're going well. Ari, hey, how you going? Top of the evening, mate. Great to have you join. Bad noise, but not worse than June, you think, at least in your list. Best opportunity to buy gold and banks next year. Hope you're going well, Siva. Zaki, good evening as well. Great to have you join us, mate. Alrighty, let's talk about what we were going to talk about tonight. Why markets have sold off and where they are. As you guys know, I'm not a financial advisor. Nothing is financial advice. It's a general discussion, hopefully an interesting one for you all. Let's talk about where we currently are positioned, however. So we're back into a bear market. This is not surprising for anyone. And also, as we go through this, we're just setting up with this new live stream style where we'll go through some data points and chat about them together as a community. So yeah, let us know if you like it. Drop in a comment. But we're back into a bear market. S&P 500 into bear market, which is 20% and lower. NASDAQ, the growthier end of the market, back into crash territory, over 30% off peak to trough. Dow Jones into bear market territory as well. I think S&P 500 has been down something like 6 of the last 6 sessions. Hasn't been pretty watching wherever you look, obviously. And so there hasn't been, I think what's been notable about this period in comparison to some of the past periods has been there's not been really anywhere to hide. US dollar's been acting as a bit of a safe haven. But other than that, it's been pretty hard work. It's been pretty difficult. It's been pretty heavy going right now. So that's kind of where we're positioned. In terms of how bad is it? That's another question. That is a question that a lot of investors are trying to make sense of. You can see here, this is a 2-year chart, I think. Yeah, so it'll be back to the top of 2020. Looking at the S&P 500, just as a bit of a proxy for global growth. Obviously, as we can see here, we're testing the June lows now in around that 3,600 level. It's fair to say we are well and truly below the 200-day MA. The trend is sloping downward. You don't have to be a rocket scientist to see that. And you can see here, it's been 110-ish days below the 200-day MA. So one of the longest streaks since 2008. It's notable. As we know, it was essentially one-way traffic coming out of the March lows in 2020. You can see it there. Obviously, markets peaked back end of last year. We kind of had our peak there at the index level, and we've been trading downwards now. We've had a couple of counter trend rallies and bounces up, but now all questions are what's going to be happening here. As you can see, we're testing the June lows. I guess most people would probably anticipate that the risks are weighted to the downside now, but this is where we're currently positioned. And obviously, the contextual background is that the growthier end of the market has been hit the most, and the interest rate sensitive end of the market was hit earliest and hardest, particularly because in a low interest rate environment, those kind of longer duration assets, longer duration cash flows are going to be kind of attributed and really bring forward those cash flows. But now that we're in this rising interest rate environment and still rising, it's hit those areas hardest. But as we talked about, this past period, we've seen a sell everything type rally. So there hasn't really been anywhere to hide. Energy, commodities earlier this year were a bit of that safe haven. Energy is obviously still outperforming, but we've seen, I think there was a kind of really heavy start to I was going to say start to September, but we're basically at the back end of September now for the energy space. So that's where we're sitting. S&P 500, lowest since December 2020. Key drivers. Now, what's happened? This past couple of weeks has been notably bad. Back end of September has been difficult. But what are the key drivers there? Now, these are not the only drivers. Obviously, there is a range of different drivers out there. But this is particularly kind of over that shorter to medium term, some of the ones that have attracted a lot of the attention. So first and foremost, that 75 basis point interest rate hike. It's not surprising. We all know that that affected the markets. Now, why did it affect the markets? It obviously wasn't to do with I guess the rate hike itself. 75 basis points was actually priced in by the market. That was where consensus was sitting, but it was actually to do with the wording and the language provided by Jerome Powell, the Federal Reserve Chairman, who's basically indicated that, hey, we're not going to be surprised if we see a recession, and this soft landing is looking a lot more difficult than we might have given credit to 4, 5, 6 months ago. So that was where a lot of fear had. There was obviously downgrades as well to the economic outlook, and the dot plots indicated a higher path towards peak rates. So that's one of them. Just seeing a couple more people coming in as well. Galooni, hey, how you going? Novonix was at the growth end of the market on the tech side. So I guess that tied into the discussion we had before. So Prominence appointed director of QXR. Interesting. Did not see that, but price up 60%. That is fascinating. Yeah, well, I'll have to have a read into that one there. Cheers for sharing. Drop in, say good day as well if you guys are joining us in the last few minutes. Another key driver that we've had is the UK movements. So essentially the market over, or the government over in the UK is providing fiscal support, tax cuts, in a way aiming to stimulate growth and avoid a recession. But obviously this is in contrast or an opposite to what the central bank's objectives are, where they're trying to raise rates to curtail demand and obviously cover inflation and, reduce that inflation. This sent mayhem throughout the bond market over in the UK and the pound. The pound was at it kind of had its biggest move since March 2020, when close to parity on the bet pound USD mark, which is, you would not have anticipated seeing that not too long ago. And we obviously saw that level achieved with the EUR and USD too. So those UK movements sent a few shock waves and ripples through, basically seeing EM, so emerging market type moves in a developed economy. Then that middle chart that you can see here, that is the 10-year yield. Yields have been soaring, as we can see right now, 4% just about, 4 handles sitting on the 10-year. We know we've got a deeply inverted yield curve, but that's obviously a fascinating one. It's also challenged the TINA alternative as well, which has the ability to affect flows out of the market, sorry. And then finally, the DXY strength. US dollar's been on absolute tear recently. That's the bottom chart there. US dollar's been on a tear, and it's got implications for the rest of the markets as well. Emerging markets, or particularly nations which have got a large proportion of dollar-denominated debt, they're affected by that. It's got implications and effects on trades, trade, import, export as well. So there's a range of implications, but these are some of the drivers that have been affecting the markets over this past period. Tim, how you going? What's up, man? Great love show. What's the next 2 weeks got lined up for us all, mate? We'll see. It's going to be an interesting one. One of the upcoming slides, we'll talk about earnings season. That's what I think a lot of people will be paying attention to, as well as the CPI inflation data prints. But earnings will give us a bit of an insight. We'll talk about why in not too long. About time with the contrarian indicator there. There's a fair bit of fear flowing through the markets at this stage, isn't it, mate? So then, what's been happening? The markets are, I guess, getting fairly comfortable with the fact that, hey, we're likely to move into a recession. And now the question is moving from, are we going into a recession to how deep will this recession be? Will it be a shallow or a particularly deep one? Ned Davis Research have a global recession model or a global recession probability model, and it's now above 98%. You can see here the yellow dots that are highlighted there. Those yellow dots are indicating when it's been at this levels before. And you can see that those kind of previous periods were during 2020 and during 2008 and 2009. So both fairly tumultuous periods that were obviously right in and around the actual recession time. So that was, this brought a fair bit of kind of eyes, I guess, onto it. But these are not the only people forecasting and modeling. There's a lot of models going on at this stage. And this feeds into the Federal Reserve's recent numbers as well, where they provided a downgrade to growth, so at the GDP level, an uptick in anticipated unemployment levels, and a downgrade in terms of, an extension in terms of how long it will take inflation. Their preferred measure is PCE inflation towards that 2% sustainable mark. So that all flowed into that. And then in terms of earnings itself, so this feeds into kind of Tim's question before. What's the next 2 weeks got lined up for us all? Obviously, as we know, a lot of this past few days and weeks has predominantly been focused in the macro sphere. So we've had the Federal Reserve rate hike, a lot of inflation discussion, talk about the labor market, talk about energy and commodities, security, and all of that. That's where a lot of the questions are playing out. But I anticipate most people are going to be looking towards and looking their views towards earnings season. And so obviously with earnings season, that's going to give us company-specific news, and also gives you sector-specific news as well, because you can identify the trends between companies within the sectors. Why is earnings important? Last earnings season or earnings quarter, mostly, obviously not all of them, but mostly companies displayed an ability to pass on the earnings kind of the rising input prices. So even though there was inflationary pressures, earnings remained relatively resolute. Obviously, it's sector by sector, company by company, but by and large, they probably beat expectations in terms of how well they were able to pass that through. We know that companies with pricing power are important, but as inflationary pressures have been more sustained and have been elevated, we know we're still in highly inflationary times. At some stage, there's going to be levels where those levels of demand can no longer be sustained. And so obviously that's going to start having an impact on earnings. So the question is, when does that happen? As we know, monetary policy operates with a lag. And so what that means is that we might not see it turn up now, even though rates have just risen 2 weeks ago. Obviously, it's not the first rate hike, but this might come into 2023. But the market is looking for signs of impact into the broader macroeconomic picture, and so are Federal Reserve and central banks around the world too. So this is why earnings season is going to be important. It'll give us an insight into sectors that are struggling, sectors that maybe have been able to wear and weather the storm. But this is going to be fascinating. So September's quarter, just about one and done, which is good. And so, yeah, we'll look into earnings season. And then, of course, we've got the midterms, the US elections as well, which is going to attract a lot of attention to the back end of this year. Not immediately, not in the next few weeks, but into the back end of the year, the campaigns will start getting a bit of attention there. So that's what will be lined up for that. Davey boy, how you going, mate? Cheers, welcome. If you guys are just tuning in, firstly, drop into the comments, say hello. Make sure you've subscribed and turn your bell notifications on as well. Plenty of live streams. We'll be dropping them at random times. Whenever there's exciting news to talk about, we'll drop live streams like this. We'll chat through the news. We'll speak about it together. You guys can share your thoughts. I'll share mine. We'll come together and it'll be good. It's good to be back with the live streams. It's been a while. On the other channel as well, ASX Investor, we've done a range of different interviews over the past period. Another interview tomorrow, actually. We did one last night with what will be the next global lithium producer. Argosy Minerals, ASX AGY, they are going to be the next global lithium carbonate producer. That's for lithium carbonate. They're looking to come online in the next few weeks to months. And so we interviewed their CEO and Managing Director, Jurko Zavella, to unpack the story with their Rincon lithium project. So you can check that out on the ASX Investor channel. But on this channel, make sure you got your bell notifications on. Spotty, evening. How you going? It was good 2 weeks ago. Might be a good time to check out the Cyberpunk patches. Take a bit of the mind off the stresses of the market. Supply chain appears to be a real issue. Yeah, we'll have to see how things kind of resolve themselves. Energy is going to be a big issue. We saw what happened with Nord Stream today as well. That's attracted a lot of attention. Obviously unresolved on that front. Where will rates land? This is a question the market has. This is a question where a lot of people have. This is a question where everyday consumers have, because this affects you if you've got a mortgage, if you've borrowed a car, if you've got a business that you need to borrow for. This affects everything. Where will rates land? But obviously, for a market lens, this is important too. So a lot of people who are awaiting the Fed pivot as a bit of an indication that maybe the bottom is in, and here we are. And so, where will rates land? Obviously, nobody knows. But the Federal Reserve gave us their insights, and that gives us kind of the insight. Oh, I just have the wrong mic on. And that gives us the insight into kind of where they're anticipating the turnaround and trajectory. So for 2022, 4.4%, that was higher than kind of they previously thought about. 4.6% for 2023, peak rates is what they've highlighted there. This is the FOMC median as well, before retracing to 3.9% in 2024 and back to a neutral rate that they've identified as 2.5% in the longer run. Now, why is this important? Because of something called the Fed pivot. About time, US housing numbers. Yeah, I saw that print actually. It shocked a few people actually. So US housing numbers, stronger purchasing numbers in the prior month. Still buying. The Fed, I think, kind of about time's analysis here is what most people thought. You know, the Fed is looking for weakness in housing starts, labor market, obviously consumption, retail sentiment, all of that. And there was a housing number print this morning that was stronger than thought. And so, yeah, is it going to be another thing for the Fed to think about? Yes, it will be as they move into the November decision. MV, good evening. Just 2 weeks ago, CXO, Agusi, Pilbara, Global Lithium, we're all hitting all-time highs. It was 2 weeks can be a long time on markets. It can be a short time on markets. But my goodness, does it almost feel like a different lifetime ago, doesn't it? Hope you're going well. Fed pivot. Why is that important? So the Fed pivot has to do with when are we going to get the turnaround in terms of Federal Reserve sentiment and decision making. Obviously, we know that the Fed put is just about dead. It's difficult to have a Fed put in inflationary times. The Fed put was the long-standing notion that the Federal Reserve would backstop the markets and kind of, they wouldn't let it fall too far. They would pivot around when they need to be. But obviously, with inflation run away, it's a lot more difficult for them to pivot. They can't pivot at these levels because they need to curtail inflation quickly, which is why I think there was a lot of shock about what happened in the UK. Obviously, that wasn't from the central bank. It was on the fiscal side, but it was contrasting policy. Now, where will the Fed pivot come in? If you had to anticipate and I guess look at the spread, consensus probably looking at around mid-2023 is when people are anticipating a pivot. Kathy Wood, as always, she's fascinating. She came out and stated that Japan and China's dollar sales could be the first sign that monetary easing is on the way. Obviously, the dollar's parabolic move puts pressure on other currencies, and it could come back to bite US competitiveness because, as we mentioned, it has the ability to affect demand, for example, of exports from the US because other countries will have lower purchasing power. So this is an interesting take on that one. On the other side, there's other people who are thinking that maybe we won't get it until 24, 25 because we've got runaway inflation. The genie's out of the bottle. They're going to have to go harder and harder and bring back Volcker style kind of action to that. But I'd say consensus, all things being equal, looks to be in and around about that mid-2023 level. JP Morgan's kind of one of their star analysts, Marko Kalanovic, came out and stated that as rapid as the Fed has raised rates in 2022, policymakers could potentially do the exact opposite in 2023. So that means the Fed could next year reverse course and slash rates, which would obviously backstop markets and potentially limit downside for stocks. That's one view. On the other side, we saw Jerome Powell come out with the Federal Reserve Insight last month. Oh, it feels like last month, but a couple of weeks ago, stating that we've always understood that restoring price stability while achieving a relatively modest increase in unemployment and a soft landing would be challenging. Powell said, we've got to get inflation behind us. Wish there was a painless way to do that, but there isn't. Higher interest rates, slower growth, and a softening labor market are all painful for the public that they serve. So they acknowledge that, but they're not as painful as failing to restore price stability and having to come back and do it down the road again. They don't want to kind of go stop, start, because that's just going to be worse for anyone. They want to tear the Band-Aid off meaningfully and significantly, but that is kind of what they're focusing on here. Deco, has Kathy Wood been right about anything lately? So, a difficult period for ARK Invest, more broadly to say the least. It will be interesting because obviously Kathy Wood's got a long-term time horizon on this, on a lot of her calls. So I guess in her mind, she's basically saying, let's wait till 2025 and beyond and see. Time will tell. Time will tell. And so this was the question that really everybody's asking. It is essentially, this is really the question that the market wants to know. Now, if we're assuming that there is a recession coming and perhaps we're in the midst of the recession, Is this just a cyclical downturn, which happens? Markets go up, they go down, the economy goes up and goes down, demand goes up, it goes down. We've obviously had an atypical disruption over the past 2 years with lockdowns and monetary policy, unlimited kind of monetary policy, essentially ultra loose, and then the virus, supply chains. So there's been a lot. So a cyclical downturn coming out of that is not surprising. Or is this something more structural where we actually see the breakdown of financial systems, which is going to have some more significant issues for longer term economic functioning? Now, this is a question that markets are really having right now. There is no one, I guess, simple answer, but this is really over the next 3, 6, 9 months what most people are hoping to get answered. And really, the answer to this is probably going to give us an indication about where things are likely to trade over the next period. If it's cyclical, maybe it'll be more of a shallow bear market. And in fact, there is data about this, that if it's more cyclical, it's a more shallow bear market. But if it's more kind of financially entrenched into the system, then that can be a longer term. So that's the question. Where are we currently sitting? As we talked about, that's where we're sitting below the June lows now with a close on yesterday's session. If we have a look at the 1 minute candles, we can see here futures are, oh, there we go, a bit of a bounce at 8 p.m. I wonder if there's been news since we opened this stream, because this is a really strong set of, obviously just on the 1 minute here, but we're basically back to neutral. We were red, so it's anticipating to see a slight red coming into the session, not a major direction one way or another. US tech is looking worse than the S&P 500 benchmark, similar type of bounce, but still below yesterday's close. So interesting time. Hasnan, hey, how you going? Argosi and Core near-term producers. Where to from here for the share price? In terms of share price, that's a whole other a whole other conversation. Obviously, nobody knows where share prices are going to go in the short to medium term, particularly with such an uncertain period up ahead. But obviously, it's going to be exciting for near-term producers because they get access and exposure to the elevated lithium prices, so they can be cash flow generative in the near to medium term. So in terms of for company progression, big positive. In terms of share price, mate, your guess is as good as mine, because right now people are just trying to work out what's happening in the markets and the macroeconomic picture, and nobody's got a clear indication of that. Spot gold market, we're below the 1700 level. This is a daily here. So we can see we broke down there. It's tested a few times over kind of this past period. That 1700 level has been a fairly key one. But obviously we've broken down now. If you look back to the, where are we looking for the March 2020 levels in here. So that was the base there. And we got in and around kind of basically coming out of that peak, out of the first lift up out of March there. We're now trading in and around that. So it's going to be fascinating to see what happens to gold. On the other side, Bitcoin as well. It's been holding relatively resolute around that 20K mark. This was in and around the peaks of the last cycle. Obviously, kind of not quite. Oh, let's go back a little bit further there. Obviously, in and around those peaks there. So it's going to be fascinating to see if this holds or if it breaks down below those levels. But as you can see here, it's been slowly trying to base in and around and form a bit of a base. So will it hold? A bit of a bottoming out happening that. All eyes on that story. Wall Street cash, this is Dow Jones here. Obviously similar trend to S&P 500 and NASDAQ. But as we can see that, we're into, let me get my measuring tool out. From the peak there, which would have been just after the Santa rally, we're now back into bear market territory. So that's 21.94, 22%. The bear market territory, obviously 20% from peak to trough there. So yeah, look, there is a lot going on markets over the next kind of week, hoping it might be maybe a bit more of a relaxed period before we get into the before we get into the earnings season itself. And then really, I think all eyes are going to be focused on the back end of this year. How are things going to go with elections? The CPI inflation prints, is inflation going to start to subside naturally? And obviously what happens to the labor market? The Fed and the central banks are really watching that labor market closely as kind of indications that, yes, monetary policy is starting to take an effect into the system. So that's going to be kind of those key focuses. Let us know what you've been thinking. We've got another interview coming out tomorrow on the channel, which I'm really, really excited for. It's going to be on the ASX Investor channel. This channel, plenty of live streams. So make sure you subscribe, turn your bell notifications on, hit the like button as well. A big thanks for joining us. Let us know what your thoughts are too on the new kind of format of these live streams. We've got plenty of videos on this channel about the lithium space, EV battery materials space, and broader macroeconomic picture. So after this stream, check those out. If you want to watch some CEO interviews to understand some of your favorite companies, head to the ASX Investor channel and check those out as well. Subscribe, turn your bell notifications on. A big thank you all for joining us. We'll see you on another live stream very, very soon. look, I know markets have been difficult to say the least over this past period. It hasn't been stable. There's been still a lot of uncertainties that hopefully will be resolved. But I think the main thing is stick to your plan. Remember that often difficult periods can bring the best opportunities. It doesn't mean that you just dive in and there's all opportunities everywhere. But difficult times are not only all negative. It is a matter of perspective and kind of sometimes, there can be the opportunities out there. So stay alert, stay well. Hope you're all going well too. Big thanks. I'm enjoying the live streams. Plenty more to come. For now, stay well and happy investing. Hey, Nick as well. Welcome. Happy investing. Thanks all. See you soon.